Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden truths in company filings. And today it looks like Urban Edge Properties has a new plan to juice up its shareholders' wallets, or at least that's the story they're selling. This is Urban Edge Properties, a real estate investment trust or REIT that owns and manages shopping centres, mostly in well-located areas with a focus on retail and mixed-use properties. You might know them from their presence in urban and dense suburban markets. The big news here is about a new way they're planning to raise money, and it involves a bunch of big names in finance. So what's happening is Urban Edge Properties, along with its operating partnership, has signed a new deal called an equity distribution agreement. Think of it like a giant umbrella that lets them sell up to $250 million worth of their company's stock whenever they feel like it. Over a period of time, they've brought in 8 big players in the finance world to help them do this. We're talking about big names like Wells Fargo Securities, Goldman Sachs, JP Morgan, and Morgan Stanley, and several others. They're acting as sales agents, essentially selling the company's shares for them. This isn't actually a brand new idea for Urban Edge Properties. They had a similar program going since 2022, but this new agreement essentially replaces that old one with a fresh, updated arrangement. This is common practice for companies that want to have a flexible way to raise capital without having to go through a whole new registration process every time. They're essentially getting their ducks in a row to be able to sell stock efficiently in the future. Now, here's where it gets a little more interesting with something called forward sale agreements. Basically, the company can arrange to sell shares in the future at a price agreed upon today. What that means is that these financial partners can borrow shares from elsewhere and immediately sell them on the open market. The company then commits to deliver those shares later, or in some cases settle the difference in cash. This is a way for the company to secure funding now, but the company doesn't actually get the cash immediately from these forward sales. They'll get the money later when they deliver the shares. This is a crucial point. Urban Edge isn't getting the cash up front from these forward sales. They only receive the money when they actually deliver the shares to the buyer, or if they settle the deal in cash. If they choose to settle by delivering shares, they'll get the cash then. But if they decide to settle with cash, they might actually have to pay money to the buyer, not the other way around. This gives them flexibility, but it also means the actual cash infusion might be delayed or even work against them if market conditions change dramatically. So how much does this all cost Urban Edge Properties? The agents, the folks selling the stock, will get paid a commission. This commission is something they'll all agree on, but it won't be more than 2% of the money they raise by selling the shares. The forward sellers who are borrowing and selling shares get their compensation in a similar way. It's basically a reduced price on the future sale of shares, capped at 2% of the average selling price of those borrowed shares. So these big financial institutions are getting paid for their services, which is standard practice in these kinds of those borrowed shares. So these big financial institutions are getting paid for their services, which is standard practice in these kinds of deals. What's also important to understand is that Urban Edge Properties isn't obligated to sell all $250 million worth of stock. They can decide how much to sell, when to sell it, and they can even stop the whole process if they want to. This gives them a lot of control and flexibility. They'll be looking at things like market demand, the price of their stock, and what other funding options are available to them before deciding how to proceed. To make all this happen legally, they filed a registration statement on Form S3 with the Securities and Exchange Commission. This document basically tells the SEC and investors what they're planning to do. It was filed on August 11th and became effective right away, meaning they're cleared to start selling shares if they choose to. They also filed a prospectus supplement which provides more detailed information about the specific offering. Like most big financial agreements, this one is packed with the usual legal stuff. It includes promises the company is making, guarantees, and agreements about how they'll handle things if something goes wrong. There are also clauses about who is responsible for what and procedures for ending the agreement. These are pretty standard boilerplate terms in these kinds of contracts, designed to protect all parties involved. And just to recap, the core document outlining all of this is the equity distribution agreement. It lays out the entire relationship and the terms under which these financial players will help Urban Edge Properties sell its stock. It's a comprehensive agreement that covers all the ins and outs of this fundraising plan. Now, looking at this filing from a broader perspective, it tells us something important about Urban Edge Properties' financial strategy. Entering into an at-the-market equity distribution agreement, especially with forward sale components, suggests a few things. First, the company is likely looking for flexible ways to raise capital to fund its operations, potential acquisitions, or debt repayment, without needing to go through a traditional equity offering, which can be slower and more expensive. The fact that they're replacing an old program with a new one indicates a proactive approach to managing their capital structure. The $255 million ceiling provides them with significant borrowing capacity if market conditions are favourable. However, the forward sale agreements introduce a layer of complexity and potential risk. While they can borrow now and pay later, the company doesn't receive the proceeds up front. This means they need to be confident in future market conditions and their ability to deliver the shares or cover any potential cash settlement obligations. If the stock price drops significantly before they settle, they could end up receiving less cash or even owing money. This strategy is often employed when a company anticipates its stock price will appreciate, enabling it to lock in a favourable funding rate for the future. It really depends on their internal forecasts and their assessment of the market. From a Warren Buffett perspective, we need to ask what this means for the underlying business. Is this expansion a sign of strong growth prospects, or is it a defensive move to shore up finances? REITs, particularly those focused on retail and mixed-use properties, can be sensitive to economic downturns and shifts in consumer behaviour. This move, while enabling future funding, doesn't tell us much about their current property performance or occupancy rates, which would be key indicators of their underlying business health. We'd want to see how their rental income and property values are trending to understand if this capital infusion is for growth or to cover potential shortfalls. This filing focussy rates, which would be key indicators of their underlying business health. We'd want to see how their rental income and property values are trending to understand if this capital infusion is for growth or to cover potential shortfalls. This filing focussy purely those focused on retail and mixed-use properties on the funding mechanism, so further digging into their financial statements would be necessary to assess the real impact. Overall, Urban Edge Properties is setting up a flexible financing tool. It allows them to tap into public markets efficiently, but with the caveat that the actual cash might not flow in immediately. This can be a smart move, but it requires careful execution and a keen eye on market dynamics. Alright, that's our breakdown of Urban Edge Properties' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.